Islamic finance really has a main place now in the regular financial industry. But of course, as it's grown, now we need standards. So when the industry first started, a lot of companies like ours would have to rely on a body of scholars, maybe local scholars or a Sharia advisory board, and there would be various opinions. But now the industry has moved beyond that, and there's a body called AOFI, which stands for the Accounting and Auditing Organization for Islamic Financial Institutions. They create standards for Islamic finance, and the nice thing is now their standards are available online for free. So if you go to aofi.org, I believe, or maybe aofi.com, you can actually download the standards for Islamic finance. And they have standards for investing. They have standard 21. They have standards on zakat. They have standards on sukuk. They have standards on insurance or Islamic insurance called takaful. And the thing is now that that is created a set of standards, we no longer have to worry about, again, finding different scholars or relying on getting the opinion of a few. AOFI brings together internationally recognized Islamic finance scholars who come and create a consensus and develop these standards. So those are the standards that we at Azad use. We use AOFI guidelines. And what these guidelines require for a stock investment is that the company itself does not have lines of business dealing with in certain areas. Some of them are pretty obvious. It shouldn't be involved in areas like alcohol, tobacco, gambling, weapons of mass destruction, unethical entertainment interests, and then in insurance. And some companies like banks and financial companies, for example, they're going to be generating significant revenue from interest, so they would be eliminated. Similarly, insurance companies are going to have contracts dealing with concepts of gambling and gharar, which are built into those contracts. So as an investment, really, you have to avoid that. The other area is also we have to avoid companies that have certain debt ratios. So AOFI's guideline is to not invest in a company that has more than 30% debt on its balance sheet. So if you're going to wonder, what does that all mean? Basically, a company is going to go and take on debt, right, to finance maybe its own growth. But we have to make sure that that company doesn't have more than 30% debt in terms of its balance sheet or the assets that it owns at that particular time. And the reason being, if you remember, that debt is also not permitted to be traded. So because we can't trade debt, trading a stock that has more than 30% debt also becomes prohibited. And finally, investors also have to purify or give away any small amount of income that may have come from an impermissible source. So to explain that, let's take, for example, an airline. A lot of you may have flown here to attend the conference. You may have noticed during your flights they may have offered sale of alcohol. Now, would you say that an airline, their line of business is alcohol sales? Probably not. Probably, you would say, the airline's primary business is transportation. They're obviously selling the alcohol at profit, but does it exceed 5% of their revenue? Now, the scholars under AOFI, and basically is internationally recognized, if a company has less than 5% revenue coming from a particular source, it can be, you can still invest in the company because it is insignificant and that is not the intention for you buying that stock, but it still needs to be purified. So the fact that it's there, and we understand that maybe a company is not reporting it, it's so insignificant, a company may not be saying alcohol sales is a line of business for us, but at the same time, you don't want that money still sitting in your portfolio and growing, because regardless, it's still impure. So purification is a way of taking out any impermissible amount of money, even if it's insignificant, and giving it away and actually dispersing it to a charity. And of course, this concept is actually different from zakat. Now, in today's society, it's sometimes very difficult to say, well, okay, I know I'm not supposed to deal with riba. Riba, is it interest? Is it excessive interest? Is it usury? How do I identify and define riba? So these are just some practical ways to see, help you recognize if you see riba in a transaction. One is if you're saying that money is guaranteed to grow only because of the passage of time. Basically, there's $5 here. Tomorrow, if you take it, it's $5.10. If you take it, it's $5.15. That's interest. Money is growing by the mere passage of time, or based on lending and borrowing. There isn't that $5 was never invested in something that is now producing a gain. The other thing that you could be aware of are terms like risk-free and guaranteed. Now, again, that can help you identify that this may be a transaction that is dealing with riba. Growth that is not based on the actual use of an underlying asset. So that's kind of like the first thing that I was talking about. If the money is just growing, but it's really not being used in any way. Interest or money that grows by lending and borrowing. Trading debt or investments with significant debt. So again, if there's any sort of trading of debt going on, that may be an indication that riba may be present. If there is a transaction where there is one clear winner or one clear loser, and in a gambling situation, it's very obvious, yes, this is gambling. But you'd be surprised in so many financial transactions, if you really break it down, that's actually what's happening. And that's why I was saying, like in insurance contracts, for example, where there's an insurance contract and the insurance contract is owned by a company, not by the policyholders. Basically, the company is betting that either they're going to win or you're going to win, based on whatever the type of contract it might be. And again, conventional annuity and insurance contracts are something to be aware of. Now, I mentioned earlier that bonds, because they are lending and borrowing, typically conventional bonds, they generate income or interest through lending and borrowing. That's riba, so that would be prohibited. So how can you then go around that prohibition to still have halal fixed income? I mentioned earlier that if you see guaranteed, be aware that that could be a transaction dealing with riba. But halal fixed income is definitely doable. The way that, again, one way for fixed income is people say, well, I own something and I rent it out, right? Or I lease it out. I get a certain amount of fixed income coming in. But there are other alternatives that exist as well. So there's a security called a sukuk, which is an asset-backed bond. I was mentioning earlier that companies that are not necessarily looking just for halal investments are using Islamic finance products. This is one of them. GE actually issued a sukuk. They wanted to raise money to fund engines, for the purchase of engines. So rather than actually going and borrowing money, they issued a sukuk, whereas the sukuk owners were actually owners of the engines, and they leased it to GE. And over time, GE paid for the use of those engines, and at the end of the term, they actually bought out the engines and paid the investors back. So it created the same mechanism, if you see, that a bond does, but it does it now through the use of an actual asset. There's also bank deposits and interest-free participation banks. Unfortunately, in the US, we don't really have these, but they are available internationally. We do have a halal fixed income fund that invests in them. So again, that's a way that you can actually get exposure to halal fixed income is through that fund. And then trade finance, these are participation-based deals, typically with commodity trading within energy. Now, if you're wondering, well, that's great, but if I don't want to invest in alcohol and tobacco and gambling and all this financial stuff with interest, how am I going to make money? What options are left for me? This is just showing you a graph of the cumulative returns of the Dow Jones US Total Stock Market Index, which is a conventional index just kind of measuring US stocks, compared to the Dow Jones Islamic Market US Total Return Index, which is an index measuring stocks that that are past the halal criteria. So you can see that actually during this time period between 1997 and 2017, you can see a pretty comparable performance during some times. You can see during, for example, this is a .com, the halal screens did better. If you look at the financial crisis, again, the halal screens did better. A big part of that is because, again, we're not investing in companies that have significant debt. So that principle, which is based on, again, yes, you want a halal, also is also from a financial standpoint, making sure that your investments are secure, right? You're investing in low debt or low leverage companies. So the idea here is really, when we look at data, investing in halal doesn't really give you, doesn't really put you behind. You're really able to stay competitive, even if you look to have a halal investment portfolio. Now, again, the idea of the stock market can be really stressful for people because they'll see their accounts going up and down. But really, rather than stressing about the fluctuations in the stock market, what's really important is actually focusing on your long-term financial goals. So I want to talk a little bit about that next. And the idea with investing really is not necessarily how much your money is going to make for you today. It's really allowing time to work for you. So with an investment, you have to remember that it's not just the asset you have, you also have time. And how are you going to manage the time of your investment? So one of the big takeaways would be to start investing as early as you can. Starting early can really make a big difference. Don't delay investing for retirement. The sooner you start, the longer your investments will have to grow. And of course, playing catch up later can be difficult and expensive. So this is just to show you, if you were to start investing $3,000 every year at 6% growth. Now 6% is a pretty reasonable rate of return that you can expect. It's nothing, astronomical or off the charts. And we assume that you're not going to touch that money during that time period. So let's see if you start investing at age 20, at age 35, or at age 45. Now if you start investing that $3,000 starting at age 20, by the time you're 65, you're going to have accumulated close to $680,000. If you wait to 35, a lot of people say, well, I'm just starting out, I just started making some money, it'd be nice to put some of this in my pocket, spend a little extra. I'll start saving later when I'm making more money, right? If you wait to age 35 to start investing that $3,000 a month, by the time you're 65, now you've only saved up about $250,000. And if you wait till age 45, it's only $120,000. So again, it's never too late, but at the same time, the earlier you can start, the better. The next question people have is, well, that's great, I should be saving, but how much really should I be saving for retirement? And really what research suggests is that you should be saving at least 15% of your annual income for retirement. Remember that whenever you're retired, you're not going to be making anything. So maybe you'll have some Social Security. Who knows if that's going to still be there by the time a lot of us are retired. And pension funds are kind of out the door. Most companies are not offering traditional pension funds anymore. So saving for yourself is really going to be the money that you're going to have. So whatever you're saving for yourself now, imagine you're my 65-year-old Fatima sitting in my recliner, wherever I'm going to be. That's who I'm paying. When I put money in my 401k, I'm actually paying her, my 65-year-old self. So again, according to research, this is the percentage you'd need to save if you wanted to retire well by age 65. So if you start investing at age 25, then you should invest about 8.8% of your income for the next 40 years. If you start at age 30, you should be investing about 12% of your income. And if you start at age 35, you should start investing 16% of your income. So you can see again, you may say I'm going to wait until I'm making more money, but then you're also going to need to be saving more in order to make up for those lost years. And of course, if your company is offering you any sort of matching funds, that's free money on the table. So if you're not participating in the 401k and your employer is matching, that may mean that you're actually leaving money there. Now, investing for retirement, there are different options available. If your employer offers a program, they may offer a 401k. If they're a nonprofit, it might be called a 403b, but they're pretty similar. There's 457 plans, which are called deferred compensation plans. There's simple IRAs. But regardless, you can ask your employer for a summary plan description, which basically will explain to you about your 401k. And in some cases, you actually can use a halal mutual fund in your employer plan. So if your employer offers you a 401k, but they give you a limited number of options, there's no halal mutual funds in there, you may end up asking them if there's a self-directed 401k that you could take advantage of. Another tool that's available as soon as you have earned income is an IRA. An IRA just simply stands for an individual retirement account. And these are one of the most powerful retirement savings tools available. They're not necessarily affiliated with an employer. They are individual, so it doesn't matter whenever you move jobs. You don't have to worry about rolling it over. You have to have earned income. If you're a spouse who's not working, but your significant other is, then you can still contribute. And in 2019, this year, it was $6,000 that you could actually put in every year. Now, the benefit of IRAs is that the money grows tax-free. So not only are we talking about how much money you can make, it's also how much money you can save in taxes. Whenever you put money into a traditional IRA, you'll be able to deduct that money up front. And then you're going to pay taxes on that money earnings whenever you withdraw it. So again, your 65-year-old self, 70, 75-year-old self is the one who's going to be paying taxes on it whenever they actually pull the money out. This can be a good option if you feel that your income is high, you want to take the tax deductions now, and you expect that when you retire, your income is going to drop. You can add money no matter what your income might be, but you're going to pay a penalty if you take the money out before age 59 and a half. So don't use these lightly, like, oh, I can just put the money in, take it out. You're going to be assessed a 10% penalty because the IRS, anytime they give you the benefit of something like a tax-deferred growth or a tax deduction, there's going to be some sort of restriction on it. And you have to have earned income, maybe from an afternoon job or something like that. These are a few examples, again, just to hopefully make it a little bit more relatable. So in this first hypothetical, we have a teenager who's starting to save and saving about $50 a month from age 15 to age 21. And again, this is with an average return of 8% per year. The IRA would grow to be about $225,000 by the time they're 70. So, again, just from 15 to 21, $50 a month, like I said, that could be an after-school job, can really end up growing into a significant chunk of money by the time they're retired. It could actually account for almost 98% could be in just growth. And again, like I mentioned earlier, this is where you really see time working for you. It's not that you're putting in a whole bunch of money, that you've made a killing and now you can invest it. You've just used time to your advantage. In this second example now, we have somebody who's investing a smaller amount but is consistent. So again, taking that $50 a month in a Roth IRA from age 23, but now to age 70. And I think a lot of us could probably find $50 a month, to put aside. And here, if you have an average return of about 8%, again, the amount would grow to about $280,000 by the time you're 70. And finally, the last example, here now again, you're starting later, you're 45, but you're saving about or investing about $400 a month. And even in this case now, your investment has grown to about $365. The next part is just talking a little bit about investing for education. Anybody, again, who may have siblings, young children, thinking about how to start saving, or even if you're looking to save for yourself, maybe for degrees, graduate degrees later on. Of course, it's best, again, here to start saving as early as possible to give the money a time to grow. But again, I would recommend looking at investing for your own retirement before you start investing for any sort of education, especially if it's your child's education. The reason being is that there are options for children when it comes to getting financial aid or loans, although that may, I know it's not advisable because of the riba issue, or they may have scholarships, they may be able to work as they go to school. There's nothing like that for retirement, so retirement, you're really on your own. There's three main types of ways that you can invest for education. One is called a 529 plan. Now these are plans that are offered by the state, so they don't have any halal investment options, although they do have good tax benefits. The money grows tax deferred. Some states will even allow you a small state income tax deduction. There are two other types of accounts, Coverdell Education Savings Accounts and UTMA accounts. These will allow you to use halal investments. And again, the idea is you have to kind of consider how much you're looking to save, how much you need the money to grow to decide which of these options might be better. So just some practical ideas in terms of tips to organize your finances. Really, I would say visualizing your goals is so important. Being able to know exactly how measurable is your goal. How attainable is it? How reasonable is it? Everyone said, well, I want to retire when I'm 45. Well, that's great, but is that attainable for you? How are you going to measure it? How much are you going to need whenever you're 45? What is your lifestyle expense going to be? So really being able to visualize what that means can help you actually start the process for planning. And when you start kind of thinking of it like that, visualizing, again, your 65-year-old self, am I going to be, do I want to be a retiree who's, at home and maybe, spending some time traveling, or am I going to be somebody who I want to start launching my second career at 65, So visualizing will help you understand what kind of planning you need to do. The next thing is also making a budget. Now that sounds pretty obvious, but you would be surprised how much people do not do this. Knowing your cash flow. If I asked you, what is your monthly expenses? Do you know the answer? Of course, every month it may not be exactly the same, but generally speaking, what do you need on a monthly basis? How much of it will you definitely need? How much of it is fixed? How much of it is for your extra spending that if something happened, yeah, you could forgo that? So creating a budget can really help you hold yourself accountable, helping you prioritize your needs, and then also being realistic when it comes to wants. And it's also going to allow you to hopefully find some opportunities. When you create a budget, it's not necessarily also about how much you're going to spend, but you might find opportunities in there. You may find ways, well, actually, you know what, I'm spending more on this category than I thought I was. I know that there's a way that I could reduce that. Oh, well, now suddenly this opens up a chunk of money that I'm going to have. I could probably invest that. So those opportunities, that $50 a month that you can squeeze out of your budget, again, if you start investing it appropriately, you saw like how powerful that can be. Debt. Avoiding debt as much as possible. And if you do have debt, really trying to pay off that high interest debt first. For a lot of my clients, when it comes to debt, they'll say, well, I have this extra money, should I pay it off? Should I pay off my debt, whether it be a mortgage or a car loan, student debt, or should I invest it? I see like there's really good returns that are available. And what I tell them is that really, when it comes to your debt, think of it as a negative rate of return. If you're paying 4% on your debt, that's a negative 4% rate of return that you have. Do you want to earn negative 4%? Use debt think of debt in that way so that you can really visualize what it ultimately does. Whatever you paid for with a loan, ultimately, once you pay off that debt, plus the interest that it's accumulating, that house or car or whatever it is going to be far more expensive than the original price tag. Credit card debt, can be, of course, a crushing burden. We saw this, of course, during the financial crisis, and sometimes it can be really difficult to free yourself from it when the interest rate really starts accumulating. So really trying to avoid credit card debt as much as possible. Don't put something on your credit card unless you know you're going to be able to pay it off that month. And of course, scheduling those automatic payments so you're not even in a situation where maybe you missed a bill and now you have interest payments you have to make. Establishing a positive cash flow. Again, this comes by first figuring out how much you're spending, budgeting, paying down your debt, and then living within your means. When it comes to investing, one thing that of course you also want to make sure you do before you start saving and investing and all of that is you want to make sure that you have an emergency fund. Now, an emergency fund is exactly that, something that you can dip into whenever there's an emergency. Your car breaks down, the roof starts leaking. You don't want to go and have to tap into your 401k at that, because remember your 401k you set aside for a long-term investment. So you really should have at least 4 to 6 months of expenses saved up to handle any kind of emergency like that. And this is enough, hopefully, to give you some peace of mind as well. even whenever the stock market is going up and down, again, you're not going to panic suddenly whenever you see maybe a drop in your stock portfolio because, well, you know, your car broke down. You know that you have your emergency fund there. And then finally, in terms of setting clear financial goals, it's really important to set specific savings goals. So again, having a purpose, an amount, a goal date, a monthly goal. And then of course you can adjust these as you go. And you can also kind of organize your finances by creating sub-accounts. So create an account for an emergency fund, create an account you know, for your home down payment. People used to say, well, I have different envelopes, right? Like where people used to put cash in different envelopes to budget for throughout the month. The concept is still there. I mean, we're in a digital age, but we can still do that. And if you're not using any sort of aggregator, which can hopefully pull in data, like for example, your credit card statements, your bank statements, your mortgage payments, an aggregator is really helpful. There's a lot of options out there, mint.com, QuickBooks. So you definitely look into that if that's something you don't have. And finally, again, think of saving and investing as paying your future self. Sometimes it's really hard to visualize, again, who I'm going to be, what I'm going to need, but really remember that's who you're paying yourself. So yes, you may have to sacrifice now, but ultimately, inshallah, that will be for your future benefit. I've seen this time and time again. I just had a client that I was working with a few years ago. We set up $500 a month that he was contributing to his children's education accounts. We had a review, we opened up the portfolio, and he was surprised how much that he had been able to save. And with college expenses going through the roof, college expenses are growing at about 6% inflation every year. So again, being able to save and invest gradually over time, being strategic, it's not rocket science, but just really creating a plan and sticking with it, that can be one of the most powerful things you do for yourself. So with that, I'm happy to take any questions that anybody might have.
You mentioned earlier that you're not supposed to, it's recommended not to trade in stock. These companies have 5% or more of their income generated by not halal means.
Right.
I'm branching off to something called churning, where you take advantage of sign-up bonuses in creating a bank account or a checking account or credit card. So, is the money that's earned by those bonuses halal? Because based on my understanding, the main source of income comes from not so halal means.
Yeah. So I'm not familiar. Can you explain a little bit about the churning, how that works?
Churning. So, a couple of bank institutions, what they will do to attract new customers is that they will offer these sign-up bonuses.
Okay.
So then if you deposit the money, you actually get like $500 or $1,000.
Right.
The same thing applies with credit cards with like points and whatnot, right?
Okay.
So is that money halal or
Yes. That's a really good question. So the question for anybody who didn't hear is, there are certain incentives that banks provide, credit cards provide. If you sign up, you'll get a $500, bonus, or even credit cards, for example, points, right? Like our points halal. We actually have, I think we have actually a white paper on this. That those incentives, again, the income is, those are really like bonuses that the company is offering you as an incentive, as a gift, not necessarily interest that is coming from it. Now, for example, though, if they say, well, if you invest, we'll pay you 5%. What they're doing in that case, they're actually taking your money, they're lending it out, and they're generating interest from that they're paying you back. In that case, that income would not be allowed. So again, I can look into it further about the whole trading thing, but I haven't really looked into seeing how those deals are. But from what you're telling me, it sounds kind of like how credit cards have thank you points, where you can use those thank you points to buy other things. And in that case, no, that would be acceptable.
But if the main source of the money of the bonus came from
the bank,
that is
right.
Big deals in interest.
Yeah,
that's
taking income.
The money comes from that source of income.
That's true.
Is that
That's a good question. That's a good point. And I would say, that probably, I can look into it more and talk to a scholar again. That's when we're talking about where we're deriving our income from. Like, are you comfortable taking money from the bank when the bank has generated that money from interest? it's a really good question, a very valid question.
Okay. I have another question about margin trading.
Yes.
Is that haram?
Yes. So margin trading the reason is because, again, you're taking a debt. And so derivative trading at the same time, anybody familiar with derivative or margin trading, what you're doing essentially is you're borrowing money that you don't have and you're using it to buy a stock or you're using it to buy something, and that creates leverage. So, it basically creates it empowers or gives you a little bit leverage and whenever you're buying something. Same thing with, similar with derivatives. A derivative actually is it's a trading security that actually doesn't have an underlying asset. For example, option trading is something maybe if you're familiar with. An option is really it's the ability to either you can have it so that it's a put or a call where you don't actually own an underlying asset. You're essentially gambling on whether that price is going to go up or down. There's no underlying asset. If you go to there's nothing actually there. So those are things you have to be really careful about. So yes, margin trading is not halal. Derivative trading isn't either.
Okay. So two questions that are kind of related. With the advent of cryptocurrency, if you just buy, let's say one Bitcoin with
Yes.
expectation that it may or may not
Yes.
grow in the future, is that technically a gamble?
Yeah. Bitcoin actually was really interesting. Whenever cryptocurrencies, the concept came out, it was really interesting to see the scholarly debate around it. Because really, what is it? Is it an asset? Is it speculation? And there were differing opinions on it. And that basically what it boiled down to is this an element of speculation or is this actually a currency? And I think in most cases, we saw that it really ended up being speculation, especially where we saw the high volatility. Now, the other question is, okay, the halal is one part. Is it a good idea? Is it a good idea to invest in cryptocurrency or in derivatives? I mean, these are very volatile, which means they carry a lot of risk. Now, somebody, and again, outside of the scope of Islamic investing, somebody who has, play money maybe, it's not geared towards any goal, which again, you have to really make sure that if your goals are all met 100%, then maybe, yes, you may have some flexibility to have additional money you might be, investing or playing around with. But regardless, you have to consider the risk in your investment. So things like cryptocurrencies, or derivatives, which have a lot of speculation involved in them, again, are not going to be something that you're going to be able to really understand the kind of risk involved. So I would really caution against them.
One more question. And by extension of that, is Forex trading haram or halal?
Yeah. So Forex trading also, same thing, because you're using speculation. Now, anytime you're trading currency, for example, it has to be spot trading. So same thing with any commodity trading. So if you have a currency or if you have a bushel of corn, for it to be halal, it has to be on the spot, meaning I have to give you the money and you immediately have. A lot of these brokerage companies will allow you to start with their regular investment of $50 a month, like if it's in an IRA, for example. So yes, you can start really, and if you have a 401k, you can ask for these funds, the Asal funds, to be offered to you. If they're not already offering it to you, you may have to ask for a self-directed 401k.
How much is the fee?
Yeah.
Management fee.
Yeah, so the fee, so every mutual fund, again, to be aware of, it's a professionally managed portfolio, so it will have an expense ratio associated with it. The expense ratio tells you, again, what are all the costs of managing the fund. The stock mutual fund that we have, the Asal Ethical Fund, is 0.99% annual fee, and the fixed income fund is 1.29%.
Is it based on the investment that we give to you or based on the
No,
profit?
so it's based, so all mutual funds are based on the investment actually that you put in. The reason is that regardless of whether the account value goes up or it goes down, the same work is really being done to manage the portfolio. Now, of course, it's in portfolio managers' best interest to, of course, grow the fund. That's why percentage fees, again, are aligned. Whenever you're doing better, the manager is also going to be paid better. When you do worse, the manager's fees are also going to be going down. But you also have to be aware of exactly how much the expense ratios are that you're paying. If you hire an investment advisor or financial planner, also be aware of how they're charging you fees. Because if they're buying you, for example, mutual funds, there's a built-in cost to those funds. Plus, they might say, well, I'm charging you, 1%, right, to help you decide what funds you need to buy and develop your plan. So just be aware that, then you're going to be paying your advisor's fee, plus if there's any mutual funds in there. And, and again, what is the total cost going to be for you?
So you mentioned before that sometimes companies don't report exactly how the revenue is broken up.
Yes.
So how can you be really sure how their revenue
Yeah,
is?
that's a good question. So how can you be really sure how the revenue is broken up if the company doesn't report it? And they're now required to report whenever it's less than 5%. So that creates, again, uncertainty there. That's why at our company, we assume up to 5% of any investment, every company that we buy, they may have up to 5% revenue coming from an impure source. We, of course, have technology that we use to do the filtering process. We filter on a monthly basis, so we take a look at the companies in the portfolio before we build the portfolio. Then every month we also run the screen again because companies are dynamic. They might take on more debt. They may enter into a subline of business that's not permissible. But you have to really be on top of it, to be honest. That's why, again, halal mutual funds are sometimes the easiest option whenever you don't have the time or the experience to be able to do a lot of that research. And again, for example, we will provide you the purification on your mutual fund if you go to the website. But again, to do it on your own, it can be challenging.
What do you think of investing in gold? Could you go sort of over the
Sure.
pros and cons and
That's
how
a good-
that compares to what you're sort of recommending here?
Yeah, so that's a good question. The question is about gold, investing in gold. And now there's a lot of ways that you can invest in gold. You can go and buy gold coins, for example, and keep them in the bank. You can also buy gold on indexes. There's GLD, which basically tracks the price of gold. There's gold mining companies that you can purchase, which essentially are like stocks. The benefits of using gold ETFs or stocks is that they're very liquid. It's very easy to, again, today you need to sell it. You don't have to take your money, take your coins out, go find somewhere to sell them. So it's a liquid option to have exposure to gold. What I would say though, think of gold really as a currency more than an investment. The reason is that whenever there's times of volatility, you'll see that gold goes up, and it's because people run to it for safety. It's an asset, people feel it's going to retain its value. But really, if you look at the long-term performance of the stock market, it's really been better. So I'm not saying that gold doesn't have a place. It may have a place in your portfolio, but especially look at it as a hedge more than I would like an active investment. Does that answer your question?
Could you go over that one more time?
Sure. So what I mean by hedge is basically a way for you to, again, have some area of protection within your portfolio. So if you're worried that the stock market might suddenly drop, or you want to have a certain part of your portfolio, which again is going to maintain a certain amount of value. Now remember though, gold can also be volatile. Gold can also drop. That may be a place to have gold in your portfolio. But for somebody who's young, who is for your retirement portfolio, I wouldn't really recommend gold in that type of portfolio because you have a long term, you have enough time to be able to withstand the ups and downs of the market. So gold really wouldn't have a place in that portfolio. The few times where, again, gold might be a part of a portfolio is where you have it basically as a type of currency exposure almost.
So what you said that it would be a more ideal investment if it were in shorter terms?
Sometimes, yes, in shorter terms, yes. And then again, if you're not looking for long-term growth for it, because the stock market probably will provide you a better long-term growth opportunity than gold will.
Oh, thank you.
What about if you buy government bonds directly from the government?
Really good question. So government bonds, if it is a conventional bond, for example, conventional bonds are lending borrowing agreements. So there's T-bills, which again, people say, well, these are really safe investments. Money market accounts, these are all lending borrowing transactions. So even if it's the government, what you're basically doing, Because you're lending the government money, and the government is promising to pay you a certain amount over time. So again, you still deal with that element of riba.
Do you?
So, this may not be related to your presentation, but it seems like from the hadith of the prophets, right? His lifestyle is very simple, right? If you wake up today and you have, find the food suffice for the day, you're rich already. This modern society forces you to hoard in some way, right?
Yes. Yeah.
You know that the money you spend in charity, it will return to you multiple times. We live in unseen, right?
Yeah.
But this modern society is so complex that you forget that the money you keep, even if it's for your 65 self, it's not your money. Yeah?
Yeah.
How can you guarantee they're going to be alive 65?
Yeah.
So it's for somebody else. It's not for your own good in the hereafter. So I like you to stress out how is the life of the companions and the prophets at the time, become such the best of the generation.
Yeah.
The Osman, the rich,
Yes.
they can always have money
Yes.
to donate.
Yes, yes. Yes, Mualaf, thank you for that question. And that's actually a really good point to make when it comes to financial planning. So probably you're also familiar with the hadith about, trust in Allah but tie your camel first, right? So the idea of planning, again, is really creating a realistic understanding and sustainable. And incorporating the elements of Islamic finance, really, like when we talk about financial planning from a conventional perspective, you're right. A lot of it is very much about how much money can I have, how much money am I going to keep, how much money am I going to give to my kids. When you start incorporating the principles of halal investing, Islamic investing, suddenly now we also have additional concepts coming in. So, for example, when we talk about purification, right, there is an investment that is here that I can benefit from. There may be an impure source, the money that's coming from, but I need to rectify that. Now, purification, we talk about it as zakah, as like it's mandatory, but if we think of it as a society, this is a way of being kind of working within the financial ecosystem, within as humanity, that we're now going to be conscious of how our wealth is being generated and where it may be causing harm from, avoid that, and wherever we can, take that and again, rectify it through charity. Also, whenever it comes to, to providing for yourself, for example, right? The other idea is in terms of sustainability, right? To, of course, not become a dependent so that you can no longer help others. Really being able to support yourself. When we do financial plans, we incorporate zakah as one of the goals, because we know that even after you retire, alhamdulillah, if you've built up assets all these years, you will continue to have zakah that you want to pay, but you're no longer going to have income coming to pay that zakah. So from an Islamic perspective, wealth really is created to be used. Assets, even if you think about zakah is it's essentially a tax on any imported money, right? When you pay zakah, if anybody's familiar with the payment of zakah, if you look on how you pay zakah on, for example, cash, is different than on assets. Maybe like if you purchased a factory and that factory is now producing something, right? The zakah is actually calculated differently to encourage you actually to invest, put that money and make it work, right? Not to necessarily to hoard it. And you can do the same thing with your investments as well. When you're putting it in stocks, it's working. It's actually being invested. It's helping society, and you are benefiting from it too, because ultimately, you're working to tie that camel so that, inshallah, when the time comes, you will still continue to be able to provide for yourself, your family, which is also incorporated within Islamically as a form of charity, supporting your loved ones, and then of course supporting charity as well. So I definitely agree with you. We really sometimes have to kind of understand where we fit when it comes to financial planning, financial understanding, but maintaining our values and our principles. And ultimately, what is the final purpose of all of it? And not losing sight of that. So thank you for that question.
Yeah, I have another question. So in terms of short-term, like 5 to 10 years investment,
Yeah.
what would you say would be the best sort of
Yeah.
alternative?
So the question is for a short-term investment. A short-term basically means that you can't take a lot of ups and downs, right? Because you're going to need the money maybe in 3 years, 4 years, 5 years. You can't afford for suddenly the stock market to be down 10% and now, oh, I need my money and it's down 10%. So the halal fixed income option that I was talking about invests in Islamic bank deposits and sukuk. We have a fund called the Azad Wise Capital Fund. It has a ticker symbol YZX. And when you invest in that, it doesn't have much volatility. So that means it doesn't fluctuate on the upside or the downside much. On the upside, it generates about 2%. On the downside, for example, last year the stock market dropped about 20% during a few months between September and December. That fund fell about 0.8 to 1%. So it also doesn't drop a lot on the downside. So you could look at halal fixed income options for that. Question, Sister Said.
Okay, so in Indonesia, we have to buy a minimum of 100 stocks. What about in US? Do you have to buy that for the minimum amount?
No, so that's a good question. So she's saying in Indonesia, there's a minimum requirement. You have to buy at least 100 stocks at a time. Sorry? No, so there's no requirement like that. You can open, for example, a brokerage account, Fidelity, Vanguard, any of these websites. And typically you can buy, you can buy a certain number of shares. I don't know if the brokerage company, some of them may restrict you to a certain number of shares you can purchase. But if you buy even like one share of a mutual fund, you've already bought maybe 40 shares, 40 stocks within that portfolio. And there's some companies out there where you buy one stock and it's more than $100. So no, there's no requirement necessarily that you have to buy a certain number of stocks or shares, but something that you should do is make sure that your account is appropriately diversified. There's that term, don't put all your eggs in one basket. You don't necessarily want to put all your savings into one stock, because what if something happens to that one particular stock? If you put it in maybe 20, 30 different companies, yes, then you've reduced your risk that one of them, yes, even if one of them maybe doesn't work out or doesn't do as well, I still have another 29 stocks there that are still maybe doing well.
Okay, so I have a second question. So for the sukuk in US, what is the minimum investment for sukuk?
Yeah. So if you go to buy an individual sukuk, they can be very expensive. Sometimes they're in the hundreds of thousands, millions of dollars. That's why we created our Wise Capital Fund. It's really to bring sukuk to the individual investor, where the minimum is now $4,000. With that fund, about 50% of it is invested in sukuk, and then another 40% in Islamic bank deposits. And then we also have some in trade finance, and about less than 10% that's invested in dividend-oriented stocks. So that way you get diversified halal fixed income. We go and invest in, for the Islamic banks portion, we invest in various different Islamic banks around the world, so that, again, we can benefit from their participation banks. So that, again, they're not just lending and borrowing money, generating revenue from interest. They're actually going and investing that money in different projects, and they're providing a halal fixed income return. And we're also diversifying the sukuk that we invest in geographically, for example, in different industries, so that, again, all your investments are not just in a few things.
We have a question on a note card, and we do have note cards on the table if you're too shy to ask, and you can just pass it forward, and we'll ask the question. So we have a question: how would a person in high school go about investing or getting an IRA?
That's a great question. So how does somebody in high school go about investing or getting an IRA? First of all, you have to have earned income. So again, it could be from an after-school job, but it has to be earned. It can't just be money that you saved from gifts along the way. So if you have at least earned income, there's different ways that you can open an IRA. What I would recommend is you look at a brokerage account. You can just Google brokerage accounts. You'll find all sorts of options out there. I mentioned some earlier: Schwab, TD Ameritrade, Vanguard, Folio, Fidelity. You can simply open an account through one of those brokerage accounts, establish an IRA. If you're in high school, probably you may not be too concerned about taxes. You probably may not made enough to having to pay a lot in taxes. So I'd recommend actually a Roth IRA, which is post-tax money that you'll be putting in, and then that money will grow tax deferred. meaning you're not going to pay taxes on it. And then when you take the money out, you're also not going to be paying taxes on it. So benefiting from the tax growth over all those years. And if there's an emergency, let's say you put in $3,000.